Investment Management During Global Conflict, a guide for Indian investors. Understanding the context. Global conflicts like the Russia-Ukraine war, the Israel-Iran tensions, or heightened NATO and U.S. involvement in regional wars significantly impact global financial markets. For investors, these events bring heightened volatility, currency fluctuations, changes in commodity prices, and shifts in trade dynamics. Understanding how wars ripple through economies and markets is crucial for managing savings and investments effectively. How war impacts markets, commodities, and energy prices. Wars often disrupt supply chains. For instance, the Russia-Ukraine conflict led to surges in oil, natural gas, and wheat prices, as these regions are major suppliers. India, being a net importer of energy, faced increased fuel costs that trickled down to inflation. Currency volatility. During geopolitical tensions, the US dollar and gold often become safe haven assets. The Indian rupee typically depreciates against the dollar during such times, impacting import costs and foreign investments. Stock market volatility. Wars create uncertainty, which can lead to sharp market corrections. Defensive sectors like pharmaceuticals, FMCG, and utilities tend to be more stable, while cyclical sectors such as banking, real estate, and automotive may face pressure. Trade disruptions. Conflicts in critical regions can affect global trade routes, leading to delays, increased costs, and disrupted supplies. This can hurt export-oriented industries in India, such as textiles and IT services. Strategies to safeguard your investments. 1. Diversification. The golden rule. What it means: spreading investments across asset classes such as equities, debt, gold, and real estate. Why it helps. Different assets react differently during a crisis. For example, gold usually performs well when markets crash, offering a hedge against equity losses. Actionable tip. Ensure at least 10 to 15% of your portfolio is in gold, physical, digital, or ETFs. 2. Prioritize liquidity. What it means: keep a portion of your portfolio in easily accessible instruments like liquid mutual funds, fixed deposits, or cash equivalents. Why it helps. In emergencies, having liquid funds ensures you can meet obligations without selling long-term investments at a loss. Actionable tip. Maintain an emergency fund covering 6-12 months of expenses. 3. Focus on defensive sectors. What it means. Invest in industries like healthcare, utilities, and FMCG, which are less impacted by market volatility. Why it helps. These sectors provide stability due to consistent demand. Actionable tip. Consider mutual funds or ETFs focused on these sectors during uncertain times. 4. Monitor geopolitical risks. What it means: stay informed about global events and their potential economic impacts. Why it helps. Being proactive allows you to adjust your portfolio before major disruptions occur. Actionable tip. Use financial news apps and subscribe to market analysis newsletters. 5. Invest in quality stocks and bonds. What it means. Choose companies with strong balance sheets, low debt, and consistent cash flows. Opt for AA-rated bonds. Why it helps. Quality investments are more resilient during economic downturns. Actionable tip. Review credit ratings and financial reports before investing. 6. Hedge against currency risk. What it means. Consider investments that benefit from a weak rupee, such as export-focused companies or international mutual funds. Why it helps. Currency depreciation impacts your purchasing power and overseas investments. Actionable tip. Diversify by including foreign equity funds in your portfolio. 7. Utilize systematic investment plans, SIPs. What it means. Invest fixed amounts regularly in mutual funds. Why it helps. SIPs reduce the impact of market volatility through rupee cost averaging. Actionable. Tip. Increase SIP contributions during market dips to buy more units at lower prices. 8. Consider inflation-protected instruments. What it means. Invest in assets that beat inflation, such as equities, inflation-indexed bonds, or real estate. Why it helps. Wars often trigger inflation due to supply chain disruptions. Actionable tip. Review real estate investment trusts, REITs, or inflation-beating debt instruments. Avoid emotional decisions, don't panic sell. Sharp market corrections can tempt investors to sell at a loss. Stay focused on your long-term goals. Don't overreact to news. Financial markets often rebound once clarity emerges, so avoid making impulsive decisions based on short-term news. Regular reviews. Periodically review your portfolio and rebalance it based on changing market conditions and personal goals. Lessons from historical conflicts. Gulf War, 1990 to 91. Oil prices skyrocketed, but markets eventually stabilized. Investors who stayed invested in quality assets saw long-term gains. Global financial crisis, 2008. Defensive strategies like gold and bonds provided stability. SIP investors benefited as markets rebounded in the following years. Russia-Ukraine War, 2022. Energy and commodity prices surged. Diversified portfolios with exposure to gold and global funds fared better. What not to do. Overconcentrate. Avoid putting all your money into a single asset class or geography. Ignore risks. Don't neglect geopolitical risks when planning investments. Time the market. Predicting market lows or highs is nearly impossible and can lead to missed opportunities. Conclusion. In times of global conflict, financial markets are unpredictable. However, Indian investors can safeguard their savings and achieve financial goals by focusing on diversification, quality investments, and maintaining a long-term perspective. By staying informed and disciplined, you can weather economic storms and emerge stronger. Remember, turbulent times don't last forever, but disciplined investments can create lasting wealth. Stay resilient and let your portfolio reflect your preparedness for any scenario.